2025 earnings conference call. Today, Shai Shore, CFO and Investor Relations Officer, will be our speaker, and both he and Mr. Cassio Bobsin, Zenvia's founder and CEO, will be available for the Q&A session. Please be advised that today's conference is being recorded, and a replay will be available at the company's IR website, where you can also access today's presentation. At this time, all participants are in listen-only mode. After the prepared remarks, there will be a question-and-answer session. For this Q&A session, we ask you to write down your question via the Q&A icon at the bottom of your screen. Your name will then be announced, and you'll be able to ask your question live. At this point, a request to activate your microphone will appear on your screen. If you do not want to open your microphone live, please write down "no microphone" at the end of your question. In this case, our operator will read your question aloud. Now, I'd like to welcome Shai Shore. Sir, the floor is yours.
Hello, everyone. Thank you for being with us here today to discuss Zenvia's second quarter and first half 2025 results. I am Shai Shore, CFO and IRO. Let's start with a snapshot of Q2 25 performance, where you can see all the main financial KPIs of the period. As we pointed out in our first quarter earnings call, the second quarter delivered a financial performance following the same trends we saw in Q1. It was another period of strong top-line growth of 24%, mainly driven by CPaaS, and also highlighted by the continued advance with the rollout of Zenvia Customer Cloud. While we are making steady progress on the evolution of Zenvia Customer Cloud and on streamlining our operations in line with our plans, as I will detail in this presentation, it's important to recognize the environment we are operating in, especially on the CPaaS side. The market remains highly volatile and extremely competitive, which has been putting pressure on our profitability in the short term. Our SaaS gross profit showed an increase for the first time since Q2 of 2024, with margins slightly up year over year, but this was more than offset by the CPaaS sharp drop of gross profit and margin. As a result, consolidated adjusted gross profit fell to 69 million reais, with gross margin down to 24%. Compared to Q1, this margin remains stable. That said, we see these pressures as temporary. With the initiatives already underway and with the continued scaling of our platform, we expect profitability levels to gradually recover and return to more normalized level by the end of the year. This drop in adjusted gross profit was partially offset by a decrease in G&A of 9 million reais, or 27% when compared to the same period of last year. The combination of strong top-line growth and streamlining efforts brought our G&A to revenues ratio down to 9% of our revenues in the quarter. As a result of all these factors, our normalized EBITDA came in at 11 million reais this quarter, below our expectations. We anticipate a progressive recovery throughout the year, and I will walk you through the reasons for that in the next slides. Here you can see the breakdown between our SaaS and CPaaS revenues. SaaS revenues grew 3% year over year in Q2, mainly from SMB customers. As you know, we are ramping up Zenvia Customer Cloud, our new core business launched in October of last year, and which is moving on as expected. We are proud to report that revenues from Zenvia Customer Cloud are up 23% in the first half of this year when compared to the same period of last year, accelerating from the 15% increase reported in Q1. We feel confident about delivering growth of 25 to 30% from Zenvia Customer Cloud in 2025, as we said earlier this year. On the rest of our SaaS business, we continue to see a tough and competitive environment, especially the enterprise segment in Brazil for our SaaS legacy solutions, which have been partially offsetting the growth coming from Zenvia Customer Cloud. We believe that the strong value the Zenvia Customer Cloud delivers sets us apart in this highly competitive segment, and we're already seeing proof of that, with the first dozen projects in the last couple of months that will help strengthen our SaaS metrics the next periods. Now, talking about CPaaS, the revenues were up by 33%, coming mainly from customers with tighter margins, and we believe this strategy will prove valuable over time as these accounts keep scaling without G&A costs. CPaaS accounted for 72% of total revenues, and this higher mix with low margin was the main responsible for the performance of our gross profits and margin, as we can see in the next slide. Here we have a comprehensive view on how gross profit and margin performed in the quarter, broken down by business segment. The first chart on the left shows the SaaS business. Adjusted gross profit was up 5% year over year to 45 million reais in Q2, with adjusted gross margin also slightly up by 1 percentage point to 55%. This is the first quarter we are seeing positive gross profit expansion in SaaS since Q2 of 24, driven by the transition into Zenvia Customer Cloud that I mentioned earlier. Another point I would like to go into more detail is the competitive landscape we are facing with enterprise clients in the SaaS business. As I mentioned earlier, this has been partially offsetting the performance of Zenvia Customer Cloud. That said, as enterprises adopt Zenvia Customer Cloud, they quickly recognize the benefits of running their customer services on a fully integrated solution. For us, this has been translated into higher quality revenues and more profitable clients. The second chart in the middle of the slide shows the CPaaS performance that was again impacted by strong volumes from clients with lower margins, coupled with the cost increase from the carriers that we mentioned last quarter. That is still being passed on to clients throughout the year. We expect to see CPaaS margins normalizing closer to 20% by Q4 of this year. Both performances mainly explain the drop in consolidated adjusted gross profit and margin that you can see in the third chart. Moving on, let's now discuss our G&A, which helped offset a bit this increase in gross profit. When comparing first half of 25 with the same period in 24, G&A expenses went down 25%, reaching 48 million reais. If we exclude the 8 million reais severance expense from Q1, this figure would be closer to 40 million reais. We have been very diligent and strict with our expenses since the end of 22, when we started our streamlining efforts. Our current level is now 1/3 of what it was in the first half of 22, and less than half of what we recorded in the 9 months of 22. Also, as a percentage of revenues, G&A is now at 8.3%, down 6.2 percentage points from the 14.5% report in the same period of 24. Excluding the severance, the ratio would be at 7% of revenues. At the end of 22, this ratio was around 18%. This strong performance is mainly related to the workforce reduction of approximately 15% announced in January that is expected to result in cost savings between 30 and 35 million reais in full year 24, already factoring in the severance expenses. Now, looking into our EBITDA, we recognize this quarter came in below our expectations for the reason I just explained. However, when we look at the trailing 12 months in June in this chart, we can see a more resilient performance, especially considering the very volatile and competitive environment we have been navigating in the recent quarters. We are consistently delivering around 100 million reais in normalized EBITDA in a 12-month period. In this sense, we are confident to be in the right direction to accelerate profitability from the second half of the year and create a solid foundation for 2026. Let me finish with the key takeaways to wrap up my prepared remarks. As we announced in January, when we disclosed our new strategic cycle, Zenvia Customer Cloud is our new core business, and 2025 is the year that we are ramping up the platform in Brazil and Latin America. We knew this process would take a toll on our short-term profitability, but we started to see first signs of performance already in this quarter. At the same time, we are making our operations leaner and stepping up our efficiency efforts, with AI playing a key role. It is shaping both how we deliver for clients and how we operate day-to-day inside the company. So in a nutshell, our focus is clear: grow faster, scale smaller, and keep deleveraging the company. As for the CPaaS, market dynamics will remain volatile, but we expect profitability levels to gradually recover and return to more normalized level by the end of the year. Back in January, we also shared that we are evaluating options to divest non-core assets. We see meaningful value in these businesses, and selective divestment could be an important lever to optimize our balance sheet. Our goal with all these actions is to build a stronger company with solid metrics that translate into real value for our shareholders. With that, I'll wrap my prepared remarks and open the floor for your questions.
We will now begin the question and answer session. Once again, for this Q&A session, we ask you to write down your question via the Q&A icon at the bottom of your screen. Your name will then be announced, and you'll be able to ask your question live. At this point, a request to activate your microphone will appear on your screen. If you prefer not to open your microphone live, please write down "no microphone" at the end of a question, and our operator will read your question aloud.
Hugo, there are some questions here on the webcast. I'll start with them and we'll keep going.
Can you put a bit more color on forward guidance for Zenvia Customer Cloud? How's Q3 looking in Q4 in terms of bookings? How's the franchise channel doing? And are you still expecting to hit the 200 million BRL target with 65 to 70 gross margin range for the full year? Um, let me start here with some with numbers, and then Cassio, feel free to add some qualitative uh, uh, points about Zenvia Customer Cloud, and there are a couple of other questions on it. Um, so in terms of numbers, as we said earlier in the year, in January, when we talked about the new strategic cycle and our focus on Zenvia Customer Cloud, we disclosed that we were expecting this business to be around 200 million reais in revenues, with growth of between 25 around 25%, and gross margin close to 70%. And we are keeping this, as you saw in our results here in the first half of the year. Zenvia Customer Cloud is growing close to 25%. It grew 23%. So it is as we were expecting, and we continue to maintain our expectations of a business around 200 million reais in revenues, and gross margin around 7%, growing close to 25%. No changes, no changes to that. Cassio, I think it would be interesting if you can share some thoughts on how is it going. There are the questions here about if we changed anything since we launched a business in October. There was an acceleration of the business now in the second quarter. Can you share us some qualitative points and your view on how where we're going with Zenvia Customer Cloud?
Sure. Although we have this seasonality on the CPaaS side, when we look at Zenvia Customer Cloud, we're doing pretty well. We're very excited with the whole performance of the business as we look not only on the revenue growth, but also on the usage of the software, which is very important in the SaaS model that is based on how much companies use our software. We're seeing a very strong adoption on this side. For instance, Q2, we had around 80% increase in total usage comparing to Q1 on Zenvia Customer Cloud, which means this block of the stream of adoption of the software is going to bring results on the short to mid term for our company. So it's doing pretty well in that sense. And about the franchising model, we launched that on Q1, so we're still in the early days of this strategy, but it's already representing around 15% of our new MRR in Brazil, where it is the country that we launched first of this model. So it's even though it's in the early days, it's already making a difference on new MRR. We have around 30 franchises that made sales. We had 0 in January, so we now have 30 around 34. And we're starting to test this model outside Brazil as well. We already have some partners operating in different countries, and we're going to evolve them into franchisees in the midterm. So expect this strategy to be in the next couple of quarters the main generator of new MRR for the business, which means we're building skill around Zenvia Customer Cloud, and this is doing pretty well business-wise. That's why when we see the targets that we're having for mid to long term on Zenvia Customer Cloud, it's being proved on the combination of new customers and software adoption, which of course translates into revenue. So we're very excited about these results.
Thanks, Cassio. Another question here. On the CPaaS side, are these tight margins the new level, or should we expect some recovery? So as I mentioned, and Cassio also just mentioned, CPaaS has been very competitive. We saw, I would, and Cassio, correct me if I'm wrong here, but the last time we saw business being that competitive was in the second half of 22, when we saw a lot of pricing pressure. But we are navigating this, and we understand that our strategy is
is the right one in terms of, and we've been accelerating revenues, which means we are competitive in pricing. That will obviously that put some pressure on margins in the short term, but that's important from a relationship perspective, and that business helps generating EBITDA after all. So it's important to keep that in mind. And also, first half of the year is usually when we have cost increases from the carriers, and we pass that through prices throughout the year. So we expect later on the year, closer to year end and Q4, to have passed through most of the cost increase that we suffered from the carriers, and therefore margins will stabilize at a higher level than it is right now. But it's a commoditized business. It gets volatile. It gets pricing pressure from time to time. There was the logic behind one of the logics behind our decision to move in the last strategic cycle to move and to diversify revenues into a different type of business, and adding value to the pure channel, which was the business back in late 2018, 2019. But it's still a good chunk of our revenues, and it's important. Although margins are under pressure, it's important because that business generates EBITDA. I don't know, Cassio, if you want to add anything on the CPaaS side in the market dynamics.
Yeah, sure. We have been executing a long-term strategy, and we're sticking to the plan. There's, of course, the maturity of the CPaaS business model, which brings more pressure on the margins. It's highly competitive. And of course, there is the volatility that affects results. That's why we understand that when we compare with a SaaS business, which is also, of course, every business is competitive in software, but is more stable, and we can grow customer base and have a more recurrent revenue that's much more reliable in terms of forecasting. So I understand that this strategy is why we IPO'd, is the one that's been executing and is doing pretty well. Did the acquisitions, are doing integrations, we launched the new product that consolidates all that, and it's performing pretty well. So I'll see that although we have this volatility, we're sticking to the plan and it's working.
Another here for you, Cassio. On the enterprise side, how are you seeing the businesses on both Zenvia Customer Cloud and the rest of SaaS? How the dynamics have been?
Sure. On the SaaS, business is pretty mature. It's low margin, high volume, and of being able to keep enterprise customers, as we are the main player, the more robust and reliable in Brazil. So we are able to keep the best customers on board. That's why we have all these big revenue on the CPaaS side. When you look at SaaS, especially Zenvia Customer Cloud, we aimed initially into SMBs. That was the beginning of the launch of the product. But as we brought this product and our whole experience with enterprise customers to some of our customers, they started to adopt as well. That's why we are seeing the adoption of Zenvia Customer Cloud by enterprise customers. That wasn't the initial focus, but is doing well. Of course, sales cycles are longer. Adoption takes more time, but we're seeing that the combination of SMBs and enterprise customers for Zenvia customers is also operating. So it's an upside on the initial strategy. And we're being able, with the whole experience that the team has and serving these customers, being able to bring that to this new product.
Thank you. Another one here. This is for me. Could you please provide some color on cash flow and divestitures? Sure. So on cash flow, and we put on the presentation a chart with it. If we look into our trailing last 12 months EBITDA, it's close to, on a normalized basis, it's close to 100 million reais, which is pretty much the same level that we saw in the last couple of quarters, which means thinking about pure cash flow. So EBITDA is about 100 million reais in 12 months. There is about 35-40 million reais in capex that you have to exclude from that EBITDA. So that leaves us with approximately 60-65 million reais in cash flow to serve the debt, which is pretty much puts us close to break even by year end. And that's why we've been analyzing alternatives to divest. There's not much we can add on selling assets on top of what we are already mentioned in our prepared remarks. We've been analyzing opportunities and looking into alternatives. And if and when there is anything new to talk about it, we'll let all the market and investors know about it. As of now, there's nothing we can add on this. How should we think about the potential divestment of CPaaS? In an interview, the CFO had mentioned that they tend to sell for one-time revenue, which would be more than $100 million. Is that achievable? That would put the company in a net cash position if you manage to sell it. So again, we can't discuss specifically any of the divestments that we have possibilities. I did mention historical. It is correct. I did mention historical transactions in CPaaS close to one-time revenue, but that's on a global basis, and it's very again, it depends on market conditions. It depends on macro environments such as interest rates, such as the volatility in the local market. So it's again, it could range, and we are looking more into divestment. It doesn't matter if it's CPaaS, if it's other SaaS that we don't see in the long term as relevant to the business. The reality is that asset divestment has to do with the leveraging balance sheet. It should be opportunistic to the leverage balance sheet, as simple as that. We understand that all our assets are important. They add value to our clients. So it's a matter of using this as a financial strategy to accelerate balance sheet deleveraging and being able actually to have a better capital structure to accelerate Zenvia Customer Cloud. So it's as simple as that. We're not sharing any numbers, any valuation now. What we can say is we are looking in an opportunistic way to the leverage balance sheet. Hugo, can you repoll to see if there are any questions alive to be made?
Sure, Shai. Again, if you have a question, please use the Q&A icon at the bottom of your screen to write it down, and we'll open your microphone. If you prefer not to open your microphone, please write "no microphone" at the end of your question, and our operator will read it aloud.
Seems like this is it, Hugo.
So this concludes our Q&A session. I would like to turn the conference back over to Mr. Cassio Bobsin for his closing
The floor for your
remarks.
questions.
I still have a question there. I'm not sure if I should answer this last one.
Sorry.
Yeah, it just came in. Cassio, what do you think the business will look like in 2 to 3 years?
Wow, what a nice question. Well, what we've been working on is to have the core of Zenvia being built around Zenvia Customer Cloud. And that means that we're working into provide companies a centralized way to manage all customer relationships, especially for B2C or massive B2B companies. And this means providing a software for marketing, sales, customer support, customer service, and customer engagement. And this is over time it's kind of technology that will be although it's nowadays it's different providers, it's very specialized providers. This is getting more unified. So we're seeing this adoption of companies using just one provider to manage all of these relationships. And as we're building these software, we see that it creates lots of benefits. When we put that in the context of AI and automation, the way we provide that for our customers is a way that helps them to automate and reduce costs, become more efficient, and provide more value to their customers. So when we look from a business perspective, we're in the right track to be the AI CX SaaS provider for these companies. And this means getting very sticky, getting recurrent revenues, which builds, of course, a strong business over time. We're not, of course, disclosing that in terms of finance, but we tend to move from these volatile revenues, low margins, to recurrent, stable, high margin business. As we've been able to optimize the whole company, we're seeing that we're able to increase recurrent revenues and reduce G&A, which brings, of course, a combination of not only a very strong growth, but with a high profitability on the whole business. That's what we're building. As a founder and CEO, we're building the foundations and we're seeing the results of this strategy. That's why I see that in the next 2 to 3 years, it's going to be a very different company financial-wise. And we're seeing that operating in the early days of Zenvia Customer Cloud. And we expect to have all this benefit in the next 2 to 3 years. So for that, I also close here the webcast. Thank you very much for all your attention and to seeing the evolution of Zenvia. We've building this strategy from long term. We just starting a new strategic cycle with Zenvia Customer Cloud at its core. And we expect that next couple quarters, we are going to understand how this is all playing out to be a very strong AI SaaS provider for Latin America and the whole world. Thank you very much.
So this concludes our Q&A session, and I'd like to turn the conference back over to Mr. Cassio Bobsin for his closing remarks.
Well, I already closed my remarks, so that's it, guys. Thank you very much. See you next time.
The conference has now concluded. Zenvia's IR team is at your disposal to answer any additional questions. Thank you for attending today's presentation. You may now disconnect. Have a nice day.